Now, I've seen a lot of people out there, like articles in the financial media, financial YouTubers say that the recession is canceled. They're celebrating that there's going to be no landing and there's going to be a bull market from here on out. I've sparsely found some articles here and there that are just cautioning that we got like a rough ride ahead, starting in just a few months, like this one here, saying disinflation will shift to deflation, hitting earnings and setting stocks lower, Morgan Stanley CIO says. So you see here, deflation could become a headwind for stocks, Morgan Stanley's Mike Wilson warned. That's because falling prices takes away from firms' pricing power, which hurts earnings. This is a slippery slope for earnings growth and hence stock valuations, which are quite extended, Wilson said. According to Mike Wilson, disinflation is about to turn into deflation, a major headwind for corporate earnings and in turn stock prices and investors have yet to take into account. And this article here, Americans are feeling better about the economy, but economists say, not so fast. American consumers haven't felt this good about the economy since September of 2021. Stocks are higher, with some strategists even suggesting a record-setting year for the S&P 500. Inflation has fallen from north of 9% to 3%, according to one metric. And all this while the U.S. labor market remains tight, with historically low unemployment levels. It's important to avoid reading too deeply into the details of a single month's report. Here we go. We remain steadfast in the view that the economy is going to take a turn for the worse within the coming months, saying that consumers are buying into the soft landing or no landing scenarios. The idea of a soft landing has been gaining traction among experts as recent economic data has pleasantly surprised them. Stock markets also did well in the second quarter, which was great news for investors. But as you can see, economists are urging caution. They point out that better than expected data doesn't mean that everything is perfect. Some indicators, like weekly job loss claims and the June jobs report, have been positive. But they still believe that challenges lie ahead. The worry about a possible recession comes from the fact that it takes time for economic policies to catch up and show their effect on the economy. And even though inflation is cooling down, it may take a long while to reach the Federal Reserve's target. And again, going back to the first article, keep in mind that deflation is when prices actually start to go down, which could be a problem for companies and the stock market. Deflation differs from disinflation, where disinflation is where inflation continues to rise but at a slower pace, which is a good thing. But when prices are falling in a deflationary situation, companies can't charge as much for their products or services, and of course that's going to hurt their corporate earnings. Right now, at least this month, or more specifically last month, the economy is doing okay, and prices are already coming down. This has led to better valuations for stocks, which is a positive thing for investors. However, we might need to keep an eye on things because if deflation becomes a reality, we need to change our investment strategies. Remember, investing is a long-term game and there are always up and downs, but I've been talking about this deflation concern for a while now. And that especially in conjunction with the contraction of the money supply. There are a number of scenarios that could play out over the next few months. The first one is the best case scenario, or the Goldilocks scenario. This is where there's no soft landing or no landing at all. Inflation continues on to a path to 2%, reaching the Fed's target, and we continue on a bull market from here on out. This seems overly optimistic, but no one says we can't dream, right? The second scenario is where interest rates get hiked this week. July CPI data in August shows a lot of disinflation and deflation across the board, with a similar report in September about August. And then the Fed decides that they're not going to hike again in September. This would be what would lead us to the Goldilocks scenario, but in this scenario, deflation would just spiral out of control. And then we start to feel the effects of this in October and November with corporate bankruptcies and job losses. And then boom, everybody would pretty much agree that, yeah, we're in a recession. A third scenario, and a bit more scary, is that the hospitality and travel industry will cause inflation to spike in July and August. And then the Fed will hike interest rates again in September, even though the effects of deflation is there and we're just not feeling it yet. And then boom, we see deflation becoming more visible and quite possibly more bank failures. This is the worst possible thing that could happen, and this is a depression alert here. Very bad. Very, very bad. Personally, I think we're going to hover somewhere between that first and second scenario. Like, it's not going to be that bad, but it's not going to be that good either. And adding to why things might not be that good, take this article here. Bond King predicts American consumers will run out of cash later this year, paving the way for a recession. All right, American consumers are on track to run out of cash later this year. Consumer spending is a key driver of economic growth. If it drops, a recession might be the result. And the government's aggressive spending during the pandemic is still buoying the economy. Gross emphasizes that both fiscal policy, right, government spending and tax rates, and monetary policy, interest rates and money supply, play significant roles in economic growth and inflation. He points out that about $4 trillion in COVID-related spending is still making its way through the economy, with consumers spending the last of their savings accounting to around $500 billion. Based on his tweet, Gross's view is that the Fed is too focused on hiking interest rates to conquer inflation when prices are rising in part because of the flood of government cash during the pandemic is still working its way through the economy. He expects that tailwind to dissipate in a matter of months. And he's not the only one concerned with a potential crash. Other market commentators have also predicted challenges for consumer spending, and also corporate profits due to less borrowing and less saving. And this is because of interest rates rising. But being informed about economic trends and policies can help make us wise financial decisions. As we move forward, we should keep a cautious eye on economic developments and plan accordingly. So let's remain optimistic and informed, but be prepared. And if you're new to my channel, be sure to give that subscribe button a pound. Same as that like button. And I'm curious to know what you think. I look forward to comments sometimes and having a conversation, even if you disagree. Sometimes I could get hundreds of views or even 1,000 views with no comments, so give me some love down below. I'd love to hear from you.